Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is April 17th edition of Market Outlook. So, interesting markets here. We got a bit of a divergence between some economic fundamentals and market action. Let's get into it right away. First of all, you can see year to date, we're moving uh, more into the positive territory. Dow leading the market up almost 3%, followed by the S&P. Everything closed up just under 2%, pretty much matching with the exception of the Russell, which really picked up. It had been lagging all year. Now it's just about flat. One thing to note, accumulation versus distribution days, right? Even though the market has rallied sharply over the last several weeks, and it has been pretty consistent and relentless, with the exception of the slight pause last week, we've got more distribution days. And in fact, we've got four of them in the diamonds. Interesting, leading index, but again, mixed view when looking at volume. Same thing with NASDAQ. Even though we've moved up nicely, and again, four distribution days versus accumulation days, which are meager. So over the last 3, 4 weeks, not good volume action. Although, again, price action trumps everything. Do we like to see confirmation with price and volume? Absolutely. Is this indicating possible distribution on the way up by institutions? Very possibly, but with cash levels so low already, cash levels really high, it's hard to believe that there's a tremendous amount of profit taking as the market just retraces back up to its levels that it basically traded in throughout 2015. Let's take a look at some of the sectors now. In terms of the sector view, one of the things that we like to see is that the market's above the 40-week or the equivalent of about the 200-day moving average. If we have that and at least 3 to 4 sectors with positive 6-month change, we consider that a pretty solidly bullish scenario. And again, as you can see, we certainly have that. Now, what still persists is the fact that XLU, which is utilities, is our leading 6-month sector right now, picked up by consumer staples. These are both conservative plays with pretty consistent yield. So in a low yield environment, or in some cases negative, it's not surprising that getting some type of return is now your leading sector. Now, the other thing that's sort of positive news is that technology is certainly picking up the number 3 slot. So technology stocks picking up, that's a good sign that there's some speculation coming back into the market. Now, the other thing to note is over the last 3 months, materials, XLB, is one of your strongest sectors. In fact, it is your strongest sector over the last 3 months. Now, a group within that sector, which is not in this table, is GDX. GDX is metal mining, specifically gold mining stocks. And that is up over 60% over the last 3 months, leading this group in general. So, inflationary whiff, very, very possible. Silver acting really quite well. And that is a good sign that it's not just gold and gold miners, but also silver in that arena as well. So let's take a look at market hotspots here. And this is a slightly different table. Again, you could see on Friday, right, which was a down day, your leading groups here, or your leading ETFs, was sugar, gold, palladium, metal mining, and Australia, a commodity-based economy. So very, very interesting. As you can see, 6-month change, gold mine, a 3-month change, Gold miners up 63%. It's been certainly a holding in our ETF portfolios. They've done very well this year. And so if you are interested, certainly take a look at some of the ETF models that we have on the website. That would be under trading ideas. The Sector Plus or the complete portfolio would indicate what we're doing over there. So that is key. So leading this rally, definitely the metals, right? And commodities. Certainly that's a positive sign. Okay, let's take a look at some of the market internals here. First of all, let's take a look at New York Stock Exchange advanced decliners. As you can see, we got under that zero level here and on up-down volume. And basically, this midline right here, when it got crossed after being overbought, was a sell signal, but it got negated. And now on this move up, the move up this week has gotten to pretty positive levels. It's running a bit rich, but again, that generally is more of a positive sign, especially when it rejects a potential sell signal and reverses. So you've got a very strong market indication here. Your McClellan oscillator also hit the zero line, generating a potential sell last week. It was negated later or about midweek on as soon as the market gathered some strength and passed above that zero line, moving into positive territory. In fact, earlier in the week, you just about got to almost an oversold level or touched it just briefly and then moved back up. So again, this indicator and the market internals turning a bit more positive. In terms of advanced declines here, advanced decline indicator not running quite as strong as the up-down volume and your McClellan, but nonetheless try to make it past that 50% level, or flat level. That's a zero. This dotted line here is really the equivalent of a neutral reading. And once we went under the neutral reading and then flipped back, that was a positive sign. So market internals looking quite a bit better for the S&P. Let's go to the NASDAQ composite. This is all the key NASDAQ stocks, not just the 100. And you can see, look, the up-down volume even worse than the S&P. We barely got really overbought. Now, we did manage to hold that midpoint or the neutral level after hitting overbought levels. And then once it sold off and could not continue and reverse through, that was your point to be concerned that there was not going to be a follow through on the downside. So up-down volume looking quite a bit better. You now have three levels, three tests here. If we get through that neutral level and past that recent low, that would be a cause of concern. Don't forget to go to this website and you can check this out every day and see what's going on. McClellan oscillator, right? This is looking at advanced declines over the next 2 to 3 weeks. Tried to generate a sell signal, certainly got overbought. The sell signal sort of kicked in right around these levels here. It immediately reversed and on that big move back up above that 200-day moving average, which is this here, and again, back in gear. Now, in terms of advanced decline, again, not really great breath for the market. So it's this is certainly one of the lagging indices at the moment. And you can see that there's quite a difference between this and the New York Stock Exchange, or really the equivalent of the S&P 500. All right, so net, we definitely got positive more positive across the board. Last week it was looking a little bit iffy. We did get that sideways to slightly down action. Whenever the market is looking like it might get into a sell signal and works sideways, that is generally a bullish sign. But again, you've got now interesting key levels, and the low of last week in the composite is your key swing point for the downside. It's a couple percentage points away, but that's the way the game is played here. That's your indication if you're looking at pure price action. I wouldn't get negative until you really start getting below what was the low of last week. All right, let's take a look at a couple more of these market internals. Okay, NASDAQ, no, excuse me, the S&P 500, new high, new low. As you can see, really strong. So not that anything's deteriorated at all. If anything, it's been holding up and being consistent as the market makes new highs. This is certainly a big positive to the market. New high, new low ratio, extremely strong, not deteriorating at all as the market moves forward. So nothing to read other than confirmation of the trend off of this indicator. Let's go to the next one. Now, NASDAQ, new high, new low ratio. And again, not too bad. Not, it did confirm the week making net new highs versus new lows. But again, you can see not nearly the strength that we have in the S&P 500. And this is the NASDAQ. So again, new high, new low ratio, really holding the midpoint here. That's a positive. When we got oversold, and we started turning up, that was your first indication that the flush was potentially finished. And again, pretty good size move off those lows and consistent with the market move up. Not major failure. But again, you're really not sitting at pretty much really strong levels like you are in the S&P. So continued relative weakness in this indicator as well, of looking at the S&P versus the NASDAQ. Couple more charts. Bollinger Bands. Looking at the VIX on the Bollinger Bands. Again, this chart here, you're looking at whenever you get down to excessive levels on the downside or potential fraudiness on the upside, we're moving above any of the key moving averages. Right now, VIX just basically trudging along the lower end of its longer term trading range. However, not excessive pessimism, or excuse me, not excessive optimism here yet. You still got some more potential movement on the upside before this indicator drops down to a level that says maybe we're really a bit out of control here. So this indicator not quite at extreme levels of optimism at all here. So we're this is still a positive reading for the overall continued strength in the market at the moment. And our last chart, what we're going to cover is the VIX short-term volatility versus 3-month volatility, 1 versus 3. Remember, we were looking like that we were starting to roll over on this rally, and guess what? The volatility reversed along with the the S&P and the rally. And again, we really need to see this thing hook back down. The fact is that we are now reversed that trend down during the mid part of last week. And so you're sort of back in gear here to the upside. So as you're moving beneath this, above this line here, but beneath the extremely overbought that's overall a positive condition. We really need now to see this thing turn over at much higher levels where this red line will be penetrating the green line. And that is not in the cards yet. It will probably take some time to develop. And of course, a breach of the recent lows set in last week of this ratio would be a sign that a correction is certainly underway. But for now, we've reversed and everything back in gear at the moment. But I want to reiterate that things change pretty quickly. We're trading price action here, and so you have to stay on top of these indicators. Go back to the website. We update this every day. It's valuable information. All right, that's pretty much it for now. I wanted to get through all these indicators and cover the overall market right from our website this week. I think we've got a pretty good picture of what's happening. And again, this is definitely a market for trading off of the charts, trying to figure out and become a macroeconomic player is pretty difficult. In fact, one of my old associates from the floor, Paul Tudor Jones, just got a $1 billion redemption. Don't feel too sorry for him. He's done okay. But nonetheless, it just shows you how difficult the environment is. Another multi-billion-dollar hedge fund is also shutting down, and also another big macro player. Those are people trying to figure out, what the stock market is doing and where it's likely to go, and play all the other investments and sort of ETF strategies around it. But they've been having a rough go because traditional relationships are not necessarily being followed at the moment. All right, that wraps it up. See you next week, and bye for now.